All right, it's Wednesday, March 1st. I am Dan Nathan. This is Market Call. That's MRKT Call. Guy is not here today. I am joined by CBW. That is Carter Braxton Worth of Worth Charting. Carter, welcome to Market Call.
Welcome indeed. Where is Guy? Is he doing something fun, I hope, or is he?
Guy is one of those guys who gets asked to speak at things. You know what I mean? And he's at one of those one of those events here. So again, he'll be back with us tomorrow. But today's Market Call is brought to you by our fine partners and data analytics partners. They are FactSet, financial data and analytics powered by Tomorrow. They power us here. They're powering me and my charts here, Carter, than you and your analytics and your charts here. So thanks to FactSet here. All right, man, let's do it. We got a lot to cover here. I know Guy is probably disappointed. He'd love to be on the mic today talking about the Rangers trade for Kane from the Blackhawks here. We are going to be at a game tomorrow night at Madison Square Garden, the two of us, and we're going to get to see his debut there. So that's exciting for Guy Adami. But right now in the markets, man, it seems like we are in a bit of a holding pattern. It seems like we are really in the hands of the data that's coming out. But if you look at all the Fed speak, and there's a lot of it, Carter, this week, it really is higher for longer. That is the message as it relates to rates. And I'm just curious, the S&P has given back, let's say, half of its gains from its highs, right, earlier this month or so. But it seems to be kind of hanging in there, man. Like, talk to me a little bit about that. That's my chart. You see the uptrend. You see the 150-day. Just so you know, people, today, every moving average in yellow is 150-day. That is an honor of CBW. Thank you.
There we go. All the honor to you too. Thank you for that. Look, it's in many ways as nuanced a moment as any, which is to say, if something is just in a steady, orderly uptrend, we know what to do, or at least in principle what to do. Stick with it. If something's just down and to the right and heading out of business like Enron or WorldCom, we know what to do. Either stay short or certainly don't be involved in the long side. It's when you're in a moment of equilibrium, when buyers and sellers are matched off, when capital coming into the market, embracing new securities is matched off with money that's exiting, it's tough to figure it out. And that's what really a pair of twos is, right? Meaning it's not a hold. Hold is a Wall Street euphemism for sell. Yep. What it is it's just not a particularly good hand. We bet big when the hand is big, a full house, a three of a kind, a straight, but a pair of twos, it's not even a pair of eights or a pair of tens. It's basically you're getting down to almost 5 random cards. And so that's what we've got here. I've got some charts of the S&P, but we might have, well, here's one of them, but let's start in the beginning. There are no lines, no judgments, no annotations. Now, one way to draw the lines is, of course, seen here. So yes, we did get above that thing, but a lot of this is just the same way a fundamental analyst will say, well, we're changing our price target from 70 to 74 because we think the gross margins are better, the buyback will be bigger, or what have you. You can always change your lines. The lines are meant to be an aid to try to figure out, look at those arrows. So does that mean just because we've overshot now checked back that we have to bounce? Well, I would say you do it the next way. You just alter the lines, and then all of a sudden, look at this next iteration. We're just back in the malaise. Forget the fact that it was strong in sort of late January, early February. What we know, and this part is incontestable, when we were at the August peak, Wall Street came out in its infinite wisdom and said, there's a new bull. We've retraced 50% of the decline. And not only was that not the case, it was the single worst time you could have committed capital in the past 6 months. We went straight down and made new lows in October. What happened in the last days of January? In the first days of February, when we hit that high, almost 4,200, it's a new bull. We're up 20%, says the Wall Street Journal, and major analysts, and all it's done is gone straight down since. Now, does it mean it has to collapse here? Not really. It's kind of a bad hand. It's a pair of twos. When you've got a bad hand, in Texas Hold'em, 75% of smart players fold when they know they've got a marginal hand to play.
Well, listen, before we get to some longer term charts in the S&P 500 that you want to take us through here a little bit, you had a great note on worthcharting.com. Check it out, people, on just your kind of a pretty good explanation, going a bit deeper than you just did on what a pair of twos are. And you have plenty of examples of that. So check that out, people. Talk to us a little bit about, okay, so we're banging up against that uptrend. We saw that even in my rudimentary chart there. Let's back it out a little bit. Let's get back to the
Yeah.
financial crisis here. And let me ask you this, Carter. For a lot of people who are watching this right now, what do you place more emphasis on, right? Because we're obviously at a level, you just gave us the Fold'em sort of thing at that uptrend here, but now you're going to show us, a chart going back, almost 15 years or so. And is there different periods where you place greater emphasis on short duration charts versus longer duration charts? I'm just curious how you think about that.
Right, there isn't. So I'm looking at all time frames as much as I can in all iterations, meaning this is a log chart versus arithmetic chart. It's weekly bars versus daily. And so what pattern interpretation is, it's current price juxtaposed against past price. And that is how you're trying to figure out future price. So if we have a second, let me put this in the fundamentals parlance. If you and I were sitting in a conference room, I've had this many times, right? And someone burst into the room and said, Dan Carter, stock XYZ just reported 14 cents for the quarter. In and of itself, that data point means nothing. It's that data point, that 14 cents earnings for the quarter, juxtaposed against past data. So what if we then learned that all the other quarters for the past 10 quarters were 50 cents, 80 cents, dollar, and it came in at 14? We're like, whoa, this is terrible. Versus someone burst in the room, stock XYZ just reported 14 cents. We're like, in and of itself, that data means nothing. But if we look back and said all the other quarters were losses, and it just put its first profit of 14, meaning the 14 cents in quarterly results is only relevant in the context of preceding results. And so current price juxtaposed against past price in all time frames is how we figure out future price. So with that, look at this chart. It has no drawings. Let's put in some lines. And what you've got here, and this is incontestable because I didn't manipulate them, they're mathematically parallel lines. If you take the 09 low, financial crisis low, with the COVID low, and you simply then add a second and a third line, you have a perfect channel. We went out through the top of that channel, and at that point in 2021, the valuation was as high as the dot-com peak. And of course, we've given it back half. We're sitting at the midpoint, literally at the midpoint. Put another iteration in, and look what we've got. Very clear. Financial crisis, low. The peak, of course, 11 October 2007. We dropped basically 50%. And there are your lines. So you can see, obviously, if you're bullish, just to get top of the channel, which I think is no chance of that. This year in 2023, we would barely make a new high, which is to say the Jan 4, 2022 highs are going to be very hard to exceed, even if you're bullish. And then, of course, do we have to get down to the lower band? We're not even in the lower band yet. We've only been in the lower band twice, the 09 low and the COVID low. I think we continue to work lower into the lower half. And ultimately, there is the very distinct possibility that we yet again touch down at the lower band as we did on the lows of 09 and the COVID low.
I'll tell you one thing, man. I mean, that is a pretty fascinating chart. And again, there was a great explanation of just kind of using the shorter dated information, the charts, and juxtaposing against the longer dated one. And when we spend all this time talking about the October lows at 3550 or whatever, and then the pre-pandemic highs at 3400 in the S&P 500, you look at that log chart going back 15 years, and you look at the level that we are at, it would just not be that hard for us to come by those sorts of levels. So I appreciate that, which leads us to yields here, Carter, because we've been talking about this. I think we were both on the same side of this, as was Guy. Last year we thought we'd see yields come in. We did have the 10-year come, got almost down to 3.25. But look at this move, that we've had. It kind of found some support. The 200-day is a little below your 150-day, and it was just really, found support right where it should have here. We're kind of consolidating right below this 4%. And again, we could spend a lot of time talking about a round number. It doesn't really mean a whole heck of a lot. But if you think about, if we want to kind of back out the 10-year chart here a little bit, it hasn't spent a lot of time over 4%, right? In the last, call it, 20 years or so. And so here's a chart that I think is probably the most important one. This is the 10-year yield going back to 1980, and it's a log chart. And why? Well, when you and I were going over these charts before, you had a little pitter patter in your heart about this one. What? This is near and dear. What's going on with the?
Well, I'll tell you, I don't know if you. I'm pretty certain of this because I haven't seen it. I think Worth Trade was the first to introduce a log chart, all data, into the written realm of late in the past 2 years. for yields. I got a lot of pushback from major portfolio managers. You're trying to do a logarithmic chart on an instrument that's a percentage. Says who? And of course I say, well, tell me why not. And then they hammer and stammer and say, well, listen, as long as you can put lines and draw them, they are valid. And the point is that there are many more touch points, as you know, on the log chart than there are on the arithmetic. But it also puts in context just how not gradual this has been. In an arithmetic chart, it looks like yields have been quietly bottoming and gently. That's not true. It's been hysterical, right? Who would have thought that pandemic low, we'd get to 35 basis points, and now we've had this overshoot. So the real question is, have you completed the overshoot? That's kind of my hunch. Let me put it in this context. I know that it's all talk to 5% and longer, but the irony is that the last day of Q3, September 30, we were at 3.82%. And here we are in March of 2023, and we're at 3.9599. I mean, rates really haven't, for all that's gone on since September, and all of the Fed and all of the data and all of the actual tightening, why are rates barely up from where they were on the last day of Q3, September 30, 2022, 3.82%. And here we are at 3.95.
Yeah, I mean, I guess when you think about the 10-year,
2 years different, right? I mean, that's
2 years. And so I guess my point is that, like, listen, at this point, the Fed and all their speakers and all the governors and everyone out there, it seems the message is very clear. It's higher for longer, right? And so we're going to have percent in the not so distant future. It might overshoot to the upside, but you might not see 10-year yields go meaningfully higher from here. And maybe that is more of a reflection on the potential recession that might come towards the back half of this year. And I think that's kind of the main point that I would make here. And I'd also make the point is that, you mentioned September 30th when the 10-year was 3.82. Well, here we are at 3.99, and we have an S&P that is, 39.60 or something like that versus, let's say, 36. We're up at least 250 points from the end of Q3, and that doesn't make a whole heck of a lot of sense to me. So I just want to make one other point though here, Carter, is that you saw the headline today about the Chinese data. And again, this was something that I think we've been talking about a lot this year. I mean, the about face that the Chinese did on zero COVID back in January was something that I think took everybody by surprise, right? And so there was a lot of enthusiasm in their stock market. I think it definitely added to the enthusiasm in our stock market. So it's funny, on a day like today, when you see this data better than expected, there's only pockets of our market that are reacting pretty well. Right now, the S&P is down 25 basis points. I see big tech more responding to what's going on in the yield market than what's going on in the Chinese market. But I also want to hit, or excuse me, the Chinese economy. But there's also pockets in energy and resources and some industrials that are acting very well. What do you make of that sort of bifurcation right now? So we have high valuation names in our market that are reacting more towards higher yields, but then we have some of these more cyclical kind of areas of our market that are reacting to the data that's better than expected in China.
Well, that's right. It's a perfect stacking chart in order in terms of the 11 sectors. Top of the heap, the only three that are up are very cyclical, right? Energy, materials, industrials, and leading at the bottom, of course, you've got rate sensitive names. So it's utilities followed by REITs, all down on the day. Yes, it's ever thus. There's always this push of money, right? It's like air in a balloon, goes from one side to the other. And that speaks to this sort of what I get back to, which is this pair of twos where the market itself is equities as an asset class are just stuck, which is, there's nothing wrong with that. Sometimes kind of things belong at a level. We are all prone to see movement, right? Yep. And this is going to break out, this is going to break down, or this one's going to get better, this one's going to get worse. And no one ever says, this one's just going to do nothing. But sometimes that's what it is. Now, things will come along to inform decision makers. Each of us, we're decision makers, and we act accordingly with our capital. But right now, it's kind of it's what equilibrium is, and there's nothing wrong with that.
Yeah, no, it feels like something's about to give, though, in my opinion, especially if we were to see, the 10-year move, above 4%, maybe hit 4.10%. I could see an S&P that is down, probably unchanged on the year. It is interesting that the, price weighted Dow is down on the year. The S&P is only up about 3.25%. right now. I think it was up, high single digits at its highs. The Nasdaq is down,
Mhm.
or it's got half of its gains on the year have been eviscerated. It's up about 8.5% or something like that. Let's talk about retail. Sometimes this is an interesting one. Last week Home Depot, after they reported and gave guidance, and the commentary was less than stellar, that stock was down 7%. Okay, and Lowe's was down in sympathy with it. A bunch of other retailers were down. Well, here we are today. Lowe's reported, gave weak guidance, bad commentary. The stock's down 6%. And you look at this thing, it's, through its 150-day moving average. And again, not a great few weeks, right? And so just think about what investors were thinking at the start of February when this stock was trading at 225. Okay. And now we have it at 193.5. And it just shows you that, again, what expectations are versus what the kind of likelihood here is of just the kind of retail environment in a higher rate environment when savings rates are coming down, consumer credit's going higher. The other one, Target, again, was trading with Walmart last week when that gave some, muted sort of guidance. But Target, assumingly had a pretty decent quarter in guidance relative to expectations. It's giving all of yesterday's gains back and then some. It's at that 150-day level. I think that's kind of interesting. And then lastly, this one, I didn't even put any lines on this. This is Costco. And you had this in a great piece that you did on Market Call last week as a basket of some of the most important retailers. I mean, look at this thing. I mean, this does not trade well. If we wanted to annotate it, there would be a little bit of a pennant formation. And so again, that's going to be a really interesting one when they report tomorrow after the close. Talk to us on just retail in general. And I know you brought some charts in the XRT, the ETF that tracks the retail space.
Yeah, I mean, obviously, the retail is such an important part of, the consumer is such an important part of the market, important part of the economy, job growth, disposable income, and you can get a lot of cues from how these big stocks out, whether they're defensive, groceries, like Walmart's essentially a grocery store, and Costco, or more let's say, discretionary, like Target. But the group, they just don't act well. And, there's great divergence in valuation. I mean, Lowe's trades at 14 times, Costco trades at 35 times. But Costco here too, like, what about that? If you could just black out instead of white out, right? Take the name off of it, and you were staring at that, and someone brought that over to your desk, said, "Look at this one," and you didn't know it was a small cap or large, biotech or software, retail or soft, and you said, "Well, yeah, what?" And you said, you got to short this. Is fantastic. Really? You got to get long this. Really? What? Based on what? It's just sort of like, yeah, let's just let someone else play with this one for a while. But I'd rather be short than long.
I have a question for you on this chart. Let's leave this up for a second here. Okay. So since the highs, okay, last spring, okay, you see now
lower highs, higher lows,
lower highs. Okay. But let me ask you this. To me, to my eye, to use another Carter-ism here, to my eye, I think the downtrend, the connection of the lower highs looks much more intact than, let's say, what I see as a series of, let's say, higher lows, because it really does look like the Jan low was below, even briefly, you know what I mean, the October low. And so the series of supposed higher
lows. Exactly
lows,
right. You're saying is that, meaning also the downtrend has more duration, right?
Yeah.
There's more time that's elapsed since April high to present versus the June low to present. But it really is just that it's tighter and tighter. You're working into a point where it will become interesting. And then that's what they say. All right, make your bets. My bet would be short.
Okay. All right. Let's look at the XRT. You got a bunch of charts here, and these are pretty fascinating, especially when you consider just the breadth of names that are in them. And then when you think about just kind of how much time and energy we spend, talking about some of the biggest names, I think this is kind of interesting. So you're saying there's 94 stocks in the XRT, $2.5 trillion in market cap. That's about the size of Apple Computer, the stock.
That's right. And what's ironic, of course, is that's a lot of stocks, but Amazon, which of course makes up maybe almost 25-30% of the entire consumer discretionary sector, Amazon has a mere 1% weight.
Yeah.
Meaning it's an equal weight ETF, so it's a great way. Big names like this, names Costco, Walmart, eBay, Walgreens, you see them, but the highest weighting right now happens to be Carvana, of all things, at 2%. After that, Sally Beauty, Abercrombie and Fitch, Boot Barn, Children's Place. So it's moving all the time, the weightings, but it's meant to capture all retail in many ways, from Foot Locker to Burlington to Wayfair and so forth. And so let's look at a chart of this very sort of, I think, useful ETF. Now, there's nothing there. Let's put something there. What do we got? It's not random. It didn't stop to the penny. I mean, within literally a penny because of PE, and it didn't stop because enterprise value to EBITDA, and it didn't stop because all the analysts that cover these decided to sell it. It stopped because charts matter, levels matter, and that is what a double top is. Now what? Let's put in some more lines. Broke trend. So now what? Does it have to go all the way down? But here's the thing. Look at that. Talk about working into the apex of a moment. That's since the COVID low. Pull this back even further. Basically, here we sit. So then you say, oh, here he goes. You're going to say it's a pair of twos again. You betcha. Meaning we want to bet when the hand is big. And the trick is to fold, to not play if you can. My bias is down, but we can really try to be big when the moments are big.
Yeah, no, I agree. And we've had some big moves in the space also. So again, I think this is definitely really an important group to keep following. And, again, some of the data that we're tracking here, I just want to kind of move, to this was from Axios this morning. It was US subprime auto delinquency rate. You see this thing, it's hitting levels that, going back to 2010, I mean, we're hitting levels that we haven't seen since then. I think that's something to keep a note of. And then here is a couple charts. This is from Charlie Bolello, who's a great follow on the Twitter, and he has a newsletter. He sends out a bunch of charts once a week here. But this is the change in total debt from 3 years ago. You see that it's coming up pretty high, and then also U.S. credit card balances year-over-year change. We're getting to levels we haven't seen in a very long time, and again, I think that kind of helps make the case of what you're seeing in the charts, Carter, as it relates to some of these retail names. This is one that just stuck out to me because it's been a bit of an outlier. This is AutoNation. And again, this is a company that I often used to compare, and I actually bought it a couple times over the last few years when Carvana was going crazy, because I thought on a valuation basis, I thought their exposure to used cars and what they were doing online and the way that they kind of write loans and everything relative to Carvana, to me, it just seemed like a layup compared to Carvana. If you were to overlay those two stocks, one's going one way, one's going the other. Look at this breakout that it just had, okay, a few weeks ago. Did this chart catch your eye at all? This is, going back to 2018 as a 5-year chart or so. But, this thing was kind of, back and filling. And then just the kind of the violence of the breakout, it's checked back to that breakout level. Is this something you probably would want to give a little more time to, or how are you thinking about a chart like this?
It's an excellent entry point, at least by my work, which is to say, we know the stock broke out. Breakouts are news related. It was a gap on the day. It was exactly a week ago. And what you only go up or down because of news in a big way, and therefore good news or bad news. It had to be good news, had to be an earnings beat, or they got FDA approval, or the chairman that no one liked finally resigned. It doesn't matter what the news is. The stock advances aggressively and now is given back all of that and then some, which is to say you get to buy it at the price before news was released, but now you have the benefit of the news. It's a reaction buy point. They speak about this in the 1940s, meaning after a strong move, people react to the strength by what? Taking profits or trying to short it. And that selling pressure not only halts the advance, but forces the stock lower. At some point, there's no more profit takers to emerge, and no one's going to short it anymore. It's already dropped from 160 to 135. I would buy it right here.
Okay. All right. And let's rip through a few of these because I want to try to get out here at 1:30. But we got a bunch more stuff to hit. Crude oil. This is one that we've been talking about a little bit here. Again, this seems to be a series of higher lows. You see the downtrend. I don't know if that's a great line or not. But again, I think it's not reacting today. It's unchanged on the Chinese data. We're seeing other areas that we just talked about that are reacting well. I think that is interesting though, that crude's not rallying, but we do see the XLE, which is large integrated, that's up a couple percent. The OIH is up a couple percent. Thoughts on the XLE here? It's right at its 150-day moving average. Is this something that you feel kind of is constructive, a little back and fill sort of action here?
Yeah, I like, actually, I'd rather be long crude. I think crude has catch-up potential into the mid-80s. We're trading here at 77, 78. Drillers remain the area, the OIH type names, Schlumberger, Halliburton, Baker versus the big integrateds. But either way, I think the most immediate trade is oil. Nat
Crude
gas
oil.
is stabilizing, and I think you can play oil long.
Yeah, let's throw up the nat gas, the UNG chart here, because we talked about it a couple weeks, and again, I think we both agreed. I think Guy was on this. We were just a little early here. It did make a new low, but it really has. If you we can back this out to 5 years, the 2020 lows were somewhere about 8.25 or so, and we got there, and now we're kind of. It looks like this really does look like you had that test after you made the call. Technically, Guy liked it fundamentally. I looked at it and looked at the options. It looks good to me, but you're still on this one. There's nothing that changes your mind on the UNG right here.
Yeah, playing for more. Just one of the more extreme readings in the series for nat gas. Second worst month ever a month ago, down some 50-60% in a matter of, again, a handful of months. It's just playing for mean reversion, playing for a bounce.
Okay, cool. Another area, resource stocks are trading pretty well today, again, on that Chinese data. Let's look at this Alcoa. This is not one that we talk about a whole heck of a lot. Up 7.25% today. You see the uptrend. You see it held its 150-day moving average. Is this one, I mean, there's a little overhead resistance here, I guess, in the high 50s. Is this one that catches your eye at all?
Yeah, perchance it touched down to the 150, just briefly went under it. If you look at the intraday charts and bounce, we put out a note on that last week, and I think this is one of the best setups in the market, large long.
Okay. All right. And here's another one. This is Freeport. And I thought this was interesting. I used a 5-year chart on this one because there was nothing there were no trend lines to be drawn to my eye at the time, Carter. But this one looked kind of interesting to me. And you see what I'm kind of doing here. You see that kind of rising 150-day. It's about $32 or so. I don't know. This one feels like it just looks a little different to me than the Alcoa. That looks like a constructive kind of bottom forming. This does not have that feel.
Well, in the sense that, right, Alcoa never participated and Freeport came ripping back to life largely due to the gold move, right?
Mm-hmm.
So whereas Alcoa is still nascent, Freeport had a massive bounce, such a bounce that it got back to what you've annotated here as the left shoulder of a prospective head and shoulders top. For it to play out as that is implied, you're talking about Freeport down into the 20s, 19, and that almost definitionally would be a hard recession.
Yeah, no doubt.
And China collapse and everything else. But
yeah, I mean, this one was not as obvious, but I like your call on Alcoa. There was a headline in Axios this morning about brisk restaurant sales here, and I thought this was kind of interesting. If you saw that grocery store sales were kind of trending lower and restaurants had just picked up. And, I think we talked about it last week, that Domino's result. And again, this is quick serve here, but, was not particularly great. It's at a really, I would say, important level going back to 2019. I'm sure this is probably one at this point is not particularly interesting to you, but I wanted to hit you on McDonald's, which has shown really good relative strength here. It's holding its 150-day. It was below it a little bit here. Carter, thoughts on this one? Because again, that dollar that's firmed up a little bit is a bit of a headwind, maybe some weaker parts of the world, that sort of thing. But this stock hangs in there. It looks pretty constructive.
Yeah, just for sure, if we can, go to Domino's first, just for that, because you're putting in one versus the other. Domino's was one of the biggest beneficiaries of COVID, and at its peak, it was trading at 45 times. That's a chart of the stock price. 45 times earnings. That's because everyone's sitting at home and these guys are bringing you pizzas. Now, I don't think there's anyone on the planet that thinks it's the greatest pizza, right? It just happens to come quick at a decent price. And look, I've had my share, but it is what it is. This is just the unwind, right? It's a natural thing. It was a very expensive stock. By contradistinction, right? McDonald's is it's the world's cafeteria. I mean, you cannot, with the exception maybe Domino's or something, you cannot get cheaper hot food anywhere and reliably cheap and in your mouth for this price. I like McDonald's, not because I like McDonald's. It's also had my share. It's a sell-off to a level of support.
All right, fair enough. I appreciate that. Let's move a little bit here. This is one I think I know what you're going to say here, but I find this headline kind of interesting for two reasons. So I every morning I read Ben Thompson and Stratechery here, and he had a note about Snapchat. not a name that he talks about too frequently, but this is a company that just released a chat bot on their platform. It might be a subscription service. He likes it here. And this is a guy who's a well-followed tech commentator. And, I've liked Snap for a couple of different reasons right now. One, I think there's a really high likelihood that TikTok gets banned here in the US in the not so distant future. I think Snap will benefit from that, from digital ad dollars going that way. But also I think from eyeballs, greater time spent on their platform. So that one looks interesting to me. This company has had some drastic cuts. I think they cut workforce, Carter. This was in the fall. They are cutting anything that's not bolted down here. They still have a product where they announced in their earnings last month, they have 750 monthly active users. And there's very few social platforms that are not owned by Google or Facebook that have that sort of usage. Okay. And so to me, I just think this is kind of a cheap, unique, kind of scarce asset. They're losing money on a GAAP basis, so things are not great here. Thoughts here, because listen, if you back this thing out, and I'm going to back it out to its 2017 IPO, it made lower lows in 2019. It was trading $5. Okay, so here it is at 10. Is this, something that if you had a fundamental bent and you could kind of get behind it, you could think about this thing, or is the chart just so bad it's not good?
Right. Well, it is. How would I say it? It has all the elements of something that is starting to stop going down, right? It's not an enduring base so far. It's not a lot of time, but it has basically found its footing. And I think it's an asymmetrical setup. If you're wrong, it's every possibility there will be, you just kind of get stuck. Bought it at 10, it goes to 9, goes to 11, back to 8, back to 10. God, we're wasting time. But it doesn't feel as though, you come in here at 10, all of a sudden it's 6, 5, we got big problems, lost a lot of money. On the upside, whereas I think it could just muddle here, that's the downside risk, not a lot. It can be something that's very asymmetrical, and that with a little luck and a little good, good results, some stabilization, things you mentioned, that many users and not outside the Google, whatever it might be, you can see this kind of thing, and we've seen it all the time, come to life and pay off big. I mean, if Carvana can go up what it's done in Wayfair, these things are up 40, 50, 60%. Why can't Snap? And so it's a speculative circumstance. I would do it. The street ironically hates it. There's 45 analysts that cover it and 32 of them have holds, which means to say they don't know what to do with it.
But I see that's the stuff.
I think that's great.
Yeah, I love that. I'll tell you what I bought a little bit today. I'm not long the stock, and I bought a little of the April 12 calls. They were offered at 50 cents. And again, that is way out of the money. So think about that. You need a move to $12.50 in, 6 weeks or so to make money on a percentage basis. That's a lot. But to your point, a couple things go right. That's just kind of a placeholder for me. And so let's see how it acts between now and then. I'm willing to risk that at some point. I might cut the cord on that and then just start to buy some stock if it's, meaningfully below 10. It got down to $9 after their earnings in January. And but it was briefly there in the aftermarket and then open the next day in the actual session at 10. So that's where it is right now. That one's interesting to me. All right, last one before we get out of here. Lots of comments there. Sorry, guys, we could not get to all of your comments or many. We're trying to incorporate some of the stuff that we see in there. But today is Tesla's Investor Day, and this is a big one. And the stock seems to be levitating in and around this $200 level. It's up about 100% from that January low, about $100. And, I tweeted this earlier today. I was just kind of looking at what expectations are for earnings this year. And again, this stock is going to need to start to, at least investors are going to need to focus a little bit more on that E. In my opinion, when you think about the valuation, 650 billion market cap company, right now, Carter, earnings are expected to be flat year over year, okay, to last year. And again, yeah, the stock was down a lot last year, but it's also up a lot from its recent lows. And when I think about the fact that the consensus, this is per FactSet, has sales up 26%, margins down a few points. We know that they've been heavily discounting. This stock to me is not pricing the potential for a recession and the potential for, let's say, kind of more competition in China, in my opinion. And that goes to that flat earnings expectation. I actually think that earnings number could be down this year, and that sales number is probably a little too aggressive, which brings me to the chart. I didn't even just do anything to this one. You see that 150-day moving average. It's kind of at a level here. And then I just put one line in there, Carter, if you want to look at this. And this goes back to that kind of late May low. And that's that kind of $200 level. It was also the level where when it broke, in late November, early December, I mean, it got cut in half. You know what I mean? So I'm curious how you're thinking about this thing, because I know that you're kind of on my side. I don't think you're as aggressive as I might be here. I am long the TLSQ, and I'm also long calls, which would mean that this stock, I'm looking for a move of 15-20% lower in the next few weeks. That's the way I'm positioned right now.
Yeah, I have it as a large short, meaning you've had a big move, a double, to a difficult level. Right? What that means is a difficult level is where prospectively shareholders act. So what does that mean? You encounter memory. Having recovered losses, massive losses, you induce those who've had their losses recoup, right, to sell. That's one type of memory. People who bought poorly, not their fault, who now have had the chance to, and will take it, many of them, to get out, to be made whole. But you've got memory from below. Whoever bought this, dumb luck or brilliance, the most astute hedge fund manager, George Soros himself, or the most hapless e-trader. When you buy something at 100 and they flip the cards over and show you 200, a lot of people say, man, I should grab this. This is just gambling. And so you're at a very difficult level. I'm a seller.
Yeah, me too. Okay, well, listen, there's a, I'm looking at the comments. There's a guy named Edmund in here. Hey, listen, Edmund, just leave your crap comments out of there. I mean, if you want to be critical about our analysis or my views on this, that, or whatever, I just think like cluttering the comment section.
It's okay. Edmund's probably never bought or sold it anyway.
Well, yeah, I mean, I get, listen, I'm happy to have all different sorts of folks with all different sorts of opinions in here. And we're trying to look at the comment section. We're trying to comment on stuff, but like your stuff is not particularly constructive. And I'm not trying to get anybody to sell anything. This is just what we do, man. I'm active in the markets. I'm out here talking about them every day. I'm trying to be really transparent, whether it be on Market Call or our podcast or on Fast Money. So, Edmund, if that's even your real name, just chill out, man. We're trying to keep things real in that comment section. So listen, I appreciate it, Carter. We really appreciate you being here for the full show while Guy is out. That's going to do it today for today's Market Call. Thanks to our sponsor, FactSet, financial data and analytics powered by Tomorrow. We will be back tomorrow at 1 p.m. Eastern with Liz Young. She is EY from SoFi. And of course, we will be looking at John Butter's earnings insight from FactSet. So thanks for everybody, even you, Edmund, for being here today on a Wednesday. Thanks, Carter. Really appreciate it.
So, and to the great guy, Adami, Audi 5000.
Audi 5000. Thanks, man. Hey, I'm going to see you on Fast Money tonight. All right?
Oh, yeah. Okay.
All right, bud. Bye.